Welcome to this month's edition of Cledara Connects. I'm Katie, I'm from the customer success team here at Cledara, and I'm joined by my co-host Paul. How are you today, Paul?
Very good. Very happy to be here.
Yeah, excited for this one. So for those of you who are new, Cledara Connects is our monthly webinar for finance folks, especially in the tech space. We bring you topics that are top of mind, and we really want to provide a space to kind of connect, inspire, and learn. And today we've got two really great speakers with us, Corinne Thompson and Yann Ranchère. We'll be talking about raising, whatever stage you're at. I'm sure that if you're in the tech space, you're going to be looking for your next round, maybe even exploring some M&A. So while the focus maybe during those processes is on the founder, finance play a really key role. And we're going to be exploring that today. So between our speakers, I think we've got a real broad breadth of experience. So let's get to know them. I'll ask them to briefly introduce themselves. So Corinne, let's start with you. Can you tell us a little about yourself and your experience?
Yeah, sure. Hi, everyone. So my background is, well, the boring part is I'm a qualified accountant by training, trained with KPMG for 5 years. And then I've been in the tech space for the last 15 years, mainly held commercial finance director roles, specifically focused on fundraising and M&A. I set up my own company at the beginning of 2023, and we do two core things. So one is we do financial due diligence for investors. So we do it for Octopus, 24 Haymarket, Ananda, Hardcore, British Patient Capital, Smedfix, Molten, Speed Invest, Illuminate. There's about 15 to 20 or so that we work with on repeat. And then on the other side, we do fractional CFO work for companies who are fundraising or going through an M&A process. So we build models, decks, data rooms, market sizing analysis, any of the collateral basically required to go out and do a fundraise. So yeah, looking forward to today. Thanks.
Thank you. Yeah, I think it's going to be really interesting to get into all of that. Yann, give us a little intro to yourself, your
Yeah,
background, what you're doing
so
today.
I'm Yann. I'm currently the founder of a company called Motley. We automate data-driven reporting. So any decks that's number heavy, we make it so much easier to produce, especially if you need to produce them regularly for different reason per customer, per time period. And then before that, I spent, I think, similar to Corinne, a lot of my time in the tech world. I was actually a CFO for a couple of days at a holding company that was being set up called Anthemis, and I was a partner in the VC fund. I led multiple investments, been on 15 plus boards as a director. So I've been on both sides of the process in many ways.
Fantastic. Well, welcome both, and thank you so much for joining us. Before we dive into it, for anyone on the webinar today, you have the Q&A box. So if you've got questions or comments for either of our speakers today, please do submit them even as we're going along, and we'll make sure we have some time at the end to address your questions. So kind of let's dive into it. I'd love to kind of start maybe quite broad, actually. I think we all know that, if you're raising the way you did 2 or 3 years ago, you're not necessarily going to get a term sheet today. So we know the market has changed. So perhaps we could start there. And Yann, from your perspective, what has changed? What is different now to 2, 3 years ago?
Yeah, so I think a couple of things. One, we're not in 2021 anymore. And I think that was an aberration in itself. And I think like anything happening in those years, I think you have to take with a pinch of salt in terms of reference data. And then I think the AI, I think, is the biggest other driver we see in the market in terms of dynamic of distinguishing between companies. We've seen the divergence happening in the public market around SaaS multiple. That has trickled down to every other stage. And now there is I feel one of the key factors is constant arbitrage question for investors around this versus quote unquote an AI equivalent or the AI play in the space. And I think that's probably one of the current driver for how different it is today to fundraise.
Corinne, are you seeing the same? Have you experienced from when you were kind of in the GoCardless CFO days to where you are now, how things are different?
Yeah, I would definitely say, as Jan said, 2020, 2021, they were a bubble, they were an anomaly, and there was big valuations then. And I'd say that's definitely come down. I'd say there's probably an increase, particularly in the UK, of like EIS funds. So there's a lot of like VCTs out there who are investing. So they're looking for companies who kind of not only fit the credentials of an EIS investment, but who also they're not going to be like knock it out of the park, pure VC type back play. But then they're also, they're going to have some kind of like a decent exit in like, 5, 6 years time. So yeah, I completely agree with what Jan's saying.
And Corinne, to kind of keep on your GoCardless days, if we can like rewind it back a bit, we'd love to know as well, what kind of role did you play in the raising at the beginning to kind of support your CFO or your founder when that was coming up for raising?
Yeah, so just to be clear, I was the head of finance, was
Yeah.
not the CFO.
Yeah.
They didn't have a CFO. And so, and look, and I joined GoCardless straight out of KPMG. So, to be frank, I was clueless. And I had been in KPMG. It's, operational finance. I joined GoCardless, and I was like, wow, this is a whole new world that I need to kind of get a handle on quickly. And particularly the commercial finance piece and more of that forward-looking piece. And I think to be in the room for fundraising and talking specifically about fundraising investment here, you want to be in as many rooms as possible around that in order to learn as quickly as possible and understand that world. And for me, at the time, there was very limited value I could add because I had no experience in it. And you can read all the textbooks and theory books you want, but until you actually get your hands dirty, it's very different, the kind of like practicalities of it. And so at the time, I just said to the CEO at the time, I was like, I will take notes. I will, hold the pen on the CRM system. I will always be the one who knows what the next step is in terms of what an investor is asking for in terms of material. As long as I can just sit in those rooms and I promise I won't say anything. And so, that was a way to get a foot in the door basically in those conversations. And working for, Hiroki, the CEO, like I learned so much from him. And then when I went to Callsign as well, the CEO there was just absolutely phenomenal. And again, I learned so much from him. And my role there was just purely fundraising and M&A activities. So yeah, like rewinding it back to the GC days, I just given where I was in my career, it was like just how much experience can I get basically. And bear in mind as well, like, we did a 5 million Series B. That was big at the time. But now like a 5 million Series B is pretty small. So it's also like all quite relative now as well.
Yeah.
Amazing.
You said a bit about your role there, and I suppose there's various different roles that you can play, and depending on what stage you are in your finance career, or maybe it's a small finance team of one, maybe you're already CFO, maybe head of finance. So something about, I know, Jan, we were speaking previously about kind of knowing a little bit your personality, knowing your role. From the VC side, what did you see from finance? Do you ever see anyone kind of playing a centerpiece, or were they more behind the scenes and that's the expectation? They're the number crunchers.
Yeah, no, I think there is like stage by stage the role might be different, like due to the importance of like complexity of finance in terms of determining the funding round characteristics, like obviously at seed and everyone. Um, but I do think like I've seen very different types of CFOs. There are CFOs that are not in the room or almost never in the room. I think that's not necessarily a good thing for them, as Corinne pointed out. I think it's a great thing to be there. There are CFOs that are in the room and just like very uh, not, not taking a strong active role, and then you have CFOs that are also part of the pitch in a way, and they are selling a certain knowledge and a certain capacity to explain and a certain storytelling around the finance. It's not, I mean, it is in a way a little bit industry dependent because some industries are more financial or require more complexity on the finance side, but it's also due personality wise, like can you hold up to the storytelling exercise that is fundraising, right? So fundraising is like obviously a due diligence, but also a storytelling exercise. And so that is a skill set in itself to be able to tell a story at the same time you're holding the numbers and you'll be able to be, you know, guaranteeing certainty over finance in a way, right? So I think
Amazing.
that's the big difference. Like you should always guarantee certainty over finance. Like your minimum viable role is to like make finance a non-event in a way. But then you can do more than that.
Definitely. I think, yeah, to stay on the numbers and the room topic, I think we were even saying in our previous call, whether you're in the room or not, your role in finance to kind of keep those numbers locked down. So, Karen, I'd love to kind of pass it to you. What are some of those like key metrics investors want to hear today when you're doing a raise?
Yeah, I do think as Jan said, like you're kind of like the goalkeeper on a football field. Like no one really notices you exist. And then if someone like, scores against you or whatever, then they're like, oh, finance didn't do their job. So like um I would say like that is the basic kind of like hygiene of like just keep the finances running. But then I also think in terms of the metrics, like the ones that I've seen, and look, different metrics come into vogue at different points in time. And so the ones that I think at the moment, which I think get a lot of scrutiny that I've seen in fundraising rounds, are your NRR, your net retention revenue. So
Yeah.
this is, how efficiently you are growing off that base of customers that you've got already. That's a super important one. I also think like ARR per FTE, particularly in the world of like AI at the moment, a lot of companies who have AI as a product are also, well, all companies are really expected to be using AI internally as well to make things as efficient as possible. So are you growing efficiently? So ARR per FTE is another one that I see a lot of. Also like rule of 40. So like how much have you historically invested versus what the ARR growth that you're seeing now over the next couple of
Mm.
months? That is another one that I think gets a lot of yeah, a lot of looking at within like fundraising rounds at the moment. So, and then you obviously have, some of the basics is like you just have, your ARR waterfalls. So, making sure that you've got outlined what is your new, your upsell, your downsell, your churn ARR, and looking at things like what's your year-on-year growth from an ARR perspective, what's your churn rate from both a logo and ARR perspective, like just some of the very kind of basic ones, but the three that I think investors really care about right now are NRR, ARR per FTE, and Rule of 40.
Amazing. Yeah, and have you got any other kind of metrics that you look at, or any ones that you'd maybe drill into a bit more
No,
there?
I think that's, I think, yeah, I think there is still some variability depending on the business, obviously, but I
Yeah.
think those are like, w- I, for most companies, we're still also in a phase where do you have a good grasp of your cost evolution? Like, how do you predict costs going forward?
Mm.
That's and I think that goes into where kind of the storytelling exercise, because the fundraising basically is an exercise in telling a story over the next 18, 24 months, like in a way, like for many startups, right? And so do you have a believable way of saying, this is the story of my costs, and can I make a rational story around how my cost is going to evolve? Is it going to stay the same? Is it's going to improve? Like I think I think just to add, like I think understanding how your cost is going to change over time, like that's also like something that's investors would pay attention to, especially today.
Yeah.
Yeah, and just to jump in on there as well, like your very, very basic metrics, because we all get very consumed within like SaaS and the SaaS lingo,
Yeah.
but like your gross profit margin, right? Like it is your basic unit economics
Yeah.
of your company. And so in terms of that cost predictability, like it's just nailing down that one and how that's going to look going forward as hopefully you get economies of scale and things like that. That one is just like super critical.
Great. And yeah, so let's say these metrics are locked down and you're working well. I think Jan, you'd previously mentioned that on a call we had that raising is, I don't want to say essentially, but it is sales in a big way, is trying to get your story across and have a compelling story as well
Yeah.
with the raise. So we'd love to know as well, how do you tell that story? And I don't know if there's any kind of resources or courses you drew inspiration on when trying to maybe build up that skill.
For me, I think it's if we're talking relatively early stage startup, right?
Yeah.
It's basically milestones. That it's a story about the next milestone you set for yourself and the trajectory, how believable you are in telling the story of the trajectory to get there. Knowing
Mhm.
it's not never going to be fully what's going to happen in reality, right? But it's like, and here I need X amount of money to achieve Y. Y should be a goal that is something that makes it feasible for you either to go um, EBITDA positive, or maybe break even on cash, or maybe raise the next round, whatever that goal is. And then what is the story you're telling that gets you to that goal from a finance perspective? And if you have super strong assumption on things that how things used to be are going to change forward, like this is what's going to get the most scrutiny, I think, to Corinne's point. Like if you make and say my gross profit is going to improve 2x over the next 18 months, well, you better justify that. Like this is the storytelling exercise you need to do. Like you need to be convince someone that this is going to happen. Like, and you have, a good plan to make it happen, and this is the driver to make it happen. And I think that's the storytelling exercise. It's really about telling the story of the futures and finding what's today believable, real in the numbers that makes this story credible for the future, in my view.
And Corinne, I guess you're working on that daily with your
Yeah.
kind of the clients you work with as well, helping them build that narrative. Is that right?
Yeah, very much so. And to build off of Jan's point, like I have nothing to add in terms of that future piece, but like also as well, just having a narrative for what happened beforehand, because
Yeah.
you're never going to be growing like a rocket ship all the time, or there'll be, a couple of months where you've hired salespeople and they don't work out, and you're trying to like, explain that story, or your gross profit margins took a hit because of, whatever reason. But like just making sure that you have very clear like explanations for like what came before, as well as looking at what's kind of like happening going forward. Like I see a lot of financial models that people build where they just show like a gap in cash, and they're like, we need to fundraise to plug this gap. And it's like, no, you need to fundraise to achieve X, Y, and Z. It's not you need to fund this, sorry, you need to fundraise because like suddenly, you know, you're going to run out of cash. And it's kind of turning that narrative around as well in terms of like, where is the business going?
Hmm.
Yeah,
Just
if you're an early stage startup, you're mostly going to run out of cash.
Yeah.
Like all your model are going to sell you that. So it's like, yes, I fully agree.
Yeah, just to dig in on that, like I guess what role does the finance team play in helping decide when is that moment to kind of go, hang on a minute, now we need to look at raising.
I personally don't think it's that finance person's role to do that. I think it's a C-suite in general game, but I think it ultimately comes down to what the founder and the board think are the right things to do, because you can go to the market, like, everyone says go out and fundraise when you have like 12 months worth of runway in the bank. It's not bad advice, but like the best time to raise capital is when you're sort of sailing high, basically on ARR and revenues, and or when you already have capital in the bank, right? So it's kind of I would say as long as finance is holding the pen on the model, and they are keeping things up to date and accurate, and they're getting input from across the business as to what the reality is, and we're not fooling ourselves, or we're not being overly optimistic or deluded in terms of like what we think are the kind of projections. And sorry, just to take a sort of step back, I always think there's a operational model that everybody within the C-suite kind of works to, and that's a very clear view of like, if we take a download of the pipeline as it stands at the moment, like where do we think we're going to get to in the next like quarter, 6 months, potentially year, and like having that very kind of like, detailed properly, and that finance should hold. And then for me, there's then an investment model, which is at the point we say we want to go out and fundraise, we have something that has a little bit more optimism in it in terms of like those future year projections, but then also has a very, very clear view of like how we would use new capital within the business. And so I think finance's role is to keep that operational model fully updated so that everybody is aware within the C-suite as to like where we are at any given point in time, both on like cash and revenues.
Great stuff.
Being realistic, and I guess do you ever see like a founder who's very yeah, I'm not unrealistic, but ambitious and having to kind of rein in?
All the time. It's my biggest No, it's not actually my biggest issue. I'd rather work with optimistic founders who are very excited for a fundraise because at the end
Yeah,
of the day, like fundraising is tiring and you
yeah,
just have to have tenacity and resistance and momentum to keep going conversation after conversation. And I think, as long as you're allowed to kind of take those kind of the collateral and tone it down a bit in terms of like that sort of optimism, but then have this very kind of like G'd up individual who then goes out and sells the business. I think that's, that for me is always the ideal situation.
And sometimes you also need to raise because you need to. Like the
Yeah.
plan didn't pan out,
Yeah.
and
Yeah.
suddenly you find yourself in a you see, and that's where I think that's where the finance role play a critical role.
yeah,
Yeah.
Is sometimes you need to raise, like because things didn't plan out the way you thought they would plan out. If you do large enterprise business, just the fact that moving a signature date by 6 to 9 months, like for an enterprise, doesn't really matter. For you, can be critical in terms of your assumptions. So I think, yeah, you also have to be able to say, hey, we're moving away from the plan. We need to reassess and we need to raise because we're not going to hit the milestones we thought we were going to hit. And we need to find a way to manage that bridge funding. I don't like to say venture debt because normally it's not what it should fund, but sometimes it is what it funds, and sometimes it works, sometimes it doesn't. But like at some points, you need to find money, and then kind of like whatever ways you find it as consequences, but like the not finding it as more consequences than the ways you find it. So I just want to be realistic. Like I've been
Yeah.
in many companies where at some point we had to raise money and we raised money and it wasn't when we thought it would be, and we made it happen not in the best way we thought it would be, but also like we get to live another day and build another story, and that's the most important thing.
Yeah.
Mm. I think something that perhaps we have to touch on is AI and it being an important element perhaps of when you're thinking about going and speaking to VCs, it being part of perhaps your long-term plan. So, I mean, is that true? Are you both seeing that that is what, investors are expecting to see that an element of that in there, if not fully an AI tool? Um, yeah, is that what you're seeing as a trend right now? Perhaps, yeah, and I can throw to you. Like, were you seeing?
Yeah, I think it's
Oh,
I think it's I would it's not a matter of putting a logo on a deck like you, but it's also genuinely like a new capability that I think is very exciting. Like irrespective of investors, not investors, like these tools can genuinely do different things. And I think the expectations is that people should be experimenting with it or finding ways to, or at least think about how it could change their business. So I think it's less about having an AI feature that I think investors will want to look at a certain consideration around that. Like, have you thought about it? And how good is your thinking about this? Or is it just saying like we're gonna slap AI on something and put it there? You can't make yourself into an AI product from one day to the other, but you can show consideration around just understanding the impact for you and how this might change the trajectory for your company. I think that is a much better pitch in my view. Um, but yeah.
hmm, makes a lot of
Yeah,
sense.
I would agree. I mean, I personally do a lot in like B2B SaaS. And so the AI, trend is very hot. I also do a lot in deep tech. So like robotics and quantum computing and fusion and hyperspectral imaging. I think the AI wave is coming with those guys in terms of like marrying infrastructure and AI. It's been very much software and AI, and now I think it's going to be like infrastructure and AI as well. I do agree with Jan, you can't just slap AI on something and be like, ta-da. But I think you have to now it's now you have to fold it in some way. I'd say the one area though that like AI hasn't quite fully reached though is finance teams in terms of like tools that we use in the finance seat. There are a couple like the Claude's actually financial modeling tool is phenomenal now. Like you can put in a few pretty decent prompts and it will spit out a solid financial model. And I think that is coming. But I think, tools, for instance, like ChartMogul or Maxio or like tools like that, there's not a huge amount of AI built into them. And I haven't seen much as well in terms of finance tools yet that incorporate AI into doing the, like metrics and forecasting and things like that.
Great. Just to pivot a bit, we just had a question come in there on the Q&A from Luis, and he says, "How do you justify raising money when you need it?" And brackets, because plans didn't turn out as expected, and you don't have a negotiation margin.
Honestly,
Go ahead.
sorry, Yann, go on.
No, go ahead. Go ahead.
So I was going to say, like fundraising can take many forms, as Jan said before, like venture debt. I mean, venture debt, they ideally like to pair it with an equity raise, and you need 12 months in the bank. So, like, if you've got those, great. You could go out and do a convertible loan note. So it could be like and you then have to spin the story, which is like, things aren't working out, but actually, like, we have these lily pads or we have a growth story in there. We just need a bit longer to prove it out, and you can raise like an uncapped CLN or something into a next round of funding. And similarly, sorry, if you're if you're EIS funded, you could do an ASA instead of a CLN. Or you could do a bridging round if your existing investors would be open to kind of like doing a round like that. You could buy yourself a bit more time through like, PAYE and things like that can be postponed. Like HMRC is pretty good at putting people on payment plans. Like there are a myriad of like mini strings that you can pull that gives you a bit more breathing room, but then you have to have a plan of like, where are we going to get this money from?
Yeah, I agree. I think it's ultimately, if you're pitching to even internal investors or external investors, like if you're pitching a story, it's the story about, here is this what's happened. We understand why. This is why it's a good thing, because now we either at minimum we understand why, or there's these early great signs coming from that, and we want to capitalize on that. You can't tell a story about everything's going well and now we need to raise, because that's not true, and everyone that's going to look at the numbers will know it's not true. Like, it's like you can't spin it out for what it isn't, I think, because that's a good average to good investors will look at your story and the numbers and will understand that it's not the case. But you need to tell the story, like you need to have a positive story still to tell, especially if you do internal investors, like bridging round, external bridging round, or anything of this kind. I think venture debt, I think the terms for venture debt also have hardened over the last couple of years. So that's probably less easier than it was to use venture debt in these moments. But there is always different ways to get, to get through. And frankly, if it's a matter of life or death, like try all of them. Like in the best possible way, but like survival is the only thing you should care about. So, I'm talking like, I think it's just because the range of scenario is so wide, right?
Yeah.
But sometimes you just have to try everything, and in any shape or form, and the story has to be coherent, consistent, optimistic. I think outright lying will always bite you in the back. But you have to be able to acknowledge the present but still tell a great story about the future, and do that.
Fantastic. Thank you. And thank you, Lewis, for the question. I know we're coming up on time now, so I just have one little kind of last quick fire one for the both of you. We know probably between the two of you, you've listened to hundreds and hundreds of pitches. If you can, just in a couple of words, what stood out to the both of you from the great ones, and maybe what made you kind of back off from the ones that weren't so great?
But I think the best one are the one Corinne's described. It's like super charismatic entrepreneur that has the ability to sell a vision and everything, but quote unquote reined in, as in grounded in reality. I think that's the best story, because you want to believe, that's your job as an investor. So you want to believe, right? But then your job is also to do due diligence. So if you can do both at the same time, like, it's just possible way, right?
Yeah.
Yeah, I would agree with that. Like, this is more secondhand information, but like my friend used to be the CFO of Revolut, and he said hearing the CEO pitch was like, to Jan's point, it was visionary, but he was so like just so relentless and targeted and focused and apparently still is. And so, and I think the marrying those two things of like the charisma and the vision, but also the just like the ability to execute, I think is yeah, is traits that maybe people have, but they just don't bring it together in the package in the pitch.
Yeah. And if you can't have it all, like that's why you have multiple voices, right? In the pitch. Like
Yeah.
if you like it's rare to have one person that can do it all. And if you do a multi-voice pitch, that's the role people can play, right?
Totally.
We've had another question come in, actually. This one's for you, Yann. Somebody's asked, you mentioned venture debt has become hardened. Can you give context as what you mean by that?
I think I think that was echoing Corinne's comments around, 12 months runway, you need a round to be raised in the same time. That's kind of becoming a de facto rule. It was much more flexible, I think, a couple of years ago, where you could get away with not having a fundraise at the same time. Maybe you could have, if you had a believable fundraise, you could get away with less than 12 months. I feel this has become much more hardened ruled over the last year, but Corinne is closer to the ground than I am. But it's my outside perception is that some of these kind of quote unquote rules have become more strict than they were before.
I agree. I mean, they also want like tier one investors on the board, right? Like it's
Yeah.
got to be a bulletin in Excel or whatever. It can't just be like, Joe Blogs who's funded the company. So yeah, and I think the ones that are attached to banks, like HSBC's venture debt arm or JP Morgan's venture debt arm, also come with a risk of like a bank's risk-based appetite. I think if you go to someone like more like Columbia Lake Partners or Salica or a Tempo, there's still an eagerness to try and be involved. But as Jan said, there's the 12-month runway, there's the tier one VC, it's got to be married with an equity round. There's still those building blocks to get over.
Yeah.
Um, Thank you for those really great questions. I guess just to kind of maybe wrap us up really quickly, is there any kind of one piece of advice or takeaway for the finance people on the call today that you'd like to kind of give them?
I mean, for me, it's be in as many of these meetings and rooms as possible. Like that's how I learned, and that's how I got better. And it was just trying to be around the people who were, having these conversations because I'd never done it before, and I needed to learn. And that for me was the best way to learn.
I would echo. I think that's the best advice. Like be in this room and read the room. Like there is other aspects that might not be finance that are super interesting to understand, and you can't learn that without being there.
Yeah. And one of my old bosses, when I was leaving KPMG, he was like, "Be in the room, but don't say anything."
That's good
And
advice.
yeah, so like also just shut your mouth, basically. So yeah, that was helpful.
Cool.
Brilliant. Well, that's a piece of advice to end on. Well, can I just say thank you both for joining us today and for that conversation. I think that was
Yeah,
really
thank you.
interesting. And thank you to the audience for your questions. They were really great. Um, we've linked out to both your profiles on LinkedIn in the invite, and we'll do that in the follow-up email as well. So if anyone would like to get in touch, I hope you don't mind them reaching out via LinkedIn. Thank you so much for joining us all today. This has been recorded and we'll be sending it out. So please share it out if you think any of your colleagues or people in your network would find this really interesting. And we're always looking for topics to bring to you. So please do let us know what you would find interesting for our next webinars coming up next year. So thank you so much again, and we'll see you next month. Have a good
Thank you.
rest of the day and
Thanks.
long weekend.
Thanks.
Thank
Yeah,
you.
Thank
thanks,
you.
Carl.